There's been a lot of conversations going on about how lower interest rates are going to negatively impact business development companies. From what I've been reading, a lot of investors are pretty confident that we're going to see widespread dividend cuts across this entire sector. The reason for this is because most BDCs hold an overwhelming majority of floating rate debt. The amount of interest these BDCs earn from this debt depends on interest rates. When rates go up, they earn more income from their portfolios. And when rates go down, which is what we're heading toward, investment income falls. For people who love high-yielding investments, this is causing a lot of concern. And as someone who holds a lot of BDCs, roughly 29% of my portfolio is allocated toward this asset class, it does have some concerns for me as well. There's no doubt that business development companies are going to enter a more difficult environment. As the Feds cut interest rates, we will likely see dividend coverage fall, and there are likely to be some cuts among this category of investments. Knowing this, a number of people are suggesting that now is the time to completely rotate out of BDCs and instead use those proceeds to hold other investments like covered call funds and closed-end funds. So in this video, I want to take a look at this Armageddon that's apparently coming for business development companies. What I've been surprised about is just how many people now think that Jerome Powell is all of a sudden going to change his tune on interest rate cuts. For some reason, a lot of investors now seem to think that he's going to start cutting rates aggressively. While that is technically a possibility, we all know this guy has been very conservative with interest rate cuts. President Trump and many others have been frustrated with how conservative this guy has been and that he hasn't been cutting rates yet. At this point, we should all know that Powell is extremely cautious, and I think it's clear that when we do get rate cuts, he's going to take things very slowly. Personally, I don't think things are going to start off with a 50 or 75 point basis cut if they do even get that low in the foreseeable future. Jerome Powell has said that tariffs could send inflation rates noticeably back up, which would likely halt rate cuts from going too far. Now, if Powell resigns or is forced out and is replaced by someone Trump appoints, then all bets are off. But I'm assuming this won't happen and Powell will serve out the rest of his term. And when Jerome Powell does get replaced, then I think we will have to revisit this conversation at some point in the future. I also want to point out that the BDC sector has already gone through dramatic interest rate cuts in the past. Changes in interest rates are naturally part of the market cycle. People seem to have forgotten that COVID was an event that took place. In 2020, interest rates were cut significantly and very quickly at that. The economy came to a halt and non-accruals among BDCs surged. It was a very difficult environment for these investments, and although it was brief, it did not lead to widespread dividend cuts. They did happen with a couple of these stocks, but certainly not among the big names in this sector like Main Street, Ares, or Sixth Street Specialty Lending. If these dramatic interest rate cuts couldn't stop their dividends, then very gradual cuts in interest rates, you would think, would be a little easier to deal with. Speaking of which, BDCs have well known for over a year that rate cuts are coming. Hopefully these companies have been preparing for this, and many have in a number of ways. I talked about this last week with Ares Capital, but all BDCs have been building up their spillover. This is the amount a BDC has left over that they could tap into to cover their regular dividend distributions should they not earn enough in a given quarter. And although it's not exactly like this, you could kind of think of it like an emergency savings account. It is true that there are negative consequences for reaching into their spillover to cover their dividend though. It would negatively impact their NAVs, which would send share prices falling for these investments. And it's entirely possible that, for whatever reason, a BDC might choose to cut their dividend if they still have a good amount of spillover remaining. In my opinion, this is one of the biggest threats for many BDCs and their dividend safety. It's very possible we could have BDCs say, hey, we think things are going to be really rough for the next couple of years, and we don't want to deplete our spillover too much, so we're just going to play things safe and cut our dividend. Unfortunately, that is a concern, and it's completely unpredictable. But if we look at the spillover rates for many of these BDCs, especially the top-tier BDCs, many of them are still well covered. Ares Capital has enough spillover to cover 3 full quarters of dividend payments if they had 0 earnings for 9 straight months. Hercules Capital currently has about 2 quarters worth of spillover, but they're still covering their quarterly dividend very comfortably and still paying a special dividend. I think it's worth mentioning that the companies BDCs typically like to invest in are less cyclical. If you look at the investment portfolio of a lot of these BDCs, you'll notice they hold a lot of service-based businesses. Although tariffs will negatively impact the economy in general, hopefully companies that offer services will be less impacted than companies that sell goods. I also haven't even talked about how BDCs react to falling interest rates. People seem to think that they can't do anything about it when we do get rate cuts, like they just have to sit there and they don't do anything to offset lower earnings. These companies respond to lower interest rates in a couple of ways. Most notably, companies flock to BDCs when rates go down. Small businesses that wanted to borrow money to expand their operations but couldn't afford it due to higher rates start coming to BDCs, which do a lot of new business during this time. BDCs will also refinance some of their debt if they borrowed when rates were much higher. That could lead to a good amount of savings for these companies. Also, lower interest rates could potentially lower non-accruals, as these struggling businesses now owe less money on the debt they took out. I know it sounds like I'm trying to paint a really rosy picture here, and I don't want to underestimate how significant falling interest rates will have on their earnings. It's still very much a large part. But BDCs have their own strategies that they employ to counteract falling investment income. Whether or not they'll actually be successful at that, we don't know yet. And I'll also add this: if BDCs really are in grave danger, then the market isn't reacting that way. Many of these stocks continue to trade near their all-time highs, especially with the ultra-high quality ones. Ares Capital is currently trading close to its all-time high. Of course, Main Street Capital is also at its all-time high as well. The same can be said for TSLX. If the market believes dividend cuts are coming for all of these companies, it sure is bizarre that they continue to rip upward. Compare that to mortgage REITs in 2022 and 2023. During that time, dividend coverage started to fall for these investments and the market sold them off. Nearly all of them did cut their dividends. But with many BDCs, their dividend coverage is also falling right now, just like it was for MREITs a couple of years ago. Yet no massive sell-off is happening. Clearly the broad market isn't showing signs of concern right now for many of these companies. I also want to highlight how resilient these companies can be. PennantPark Floating Rate Capital has never gone through a dividend cut. But look at how much they struggled in 2020 and 2021 during COVID. They needed 30 cents a quarter to fully cover their dividend. Yet we can see they earned 27 cents, 26 cents, 26 cents, and 27 cents, and they went a long time without covering their dividend from their earnings. So if a BDC doesn't cover their dividend for a quarter or two, it definitely doesn't mean you should abandon ship. I want to summarize everything with this. Going forward, it is going to be more difficult for these companies. Their earnings will go down, and we can expect there to be some dividend cuts in this sector. But I strongly disagree with the idea of selling out of all BDCs. I don't think we're anywhere close to coming to that kind of conclusion. Now, my advice would be to definitely sell out of lower quality BDCs, but not the higher quality ones at this time. This is going to be something we'll need to closely monitor, and I will provide updates as time goes on. What are the lower quality BDCs that should be avoided and even sold? I'll discuss that next week. In my opinion, the scariest thing besides massive declines in investment income would be this: a company board deciding to cut their dividend just to play it safe when they still have a good amount of spillover. That's something that's impossible to predict, which is unfortunate. I have no plans to sell any of my BDCs right now. Like I said, we'll have to keep monitoring things, but no matter what happens, all we can do is hope. Hope that Main Street Capital will finally go on sale soon. But with that being said, that's going to wrap up today's video. If you'd like to connect with me and see what's inside of my own high-yielding dividend portfolio, then feel free to check me out over on Patreon. You'll be notified when I make trades, and you'll get access to our Discord with other high-yielding investors. Thanks again for watching. Please be sure to like this video and subscribe if you want more high-yielding investment content. Thanks again for watching, and I hope you all have a great day.